Hey guys, I'm Nick.
And I'm Tony.
And we're the Sicilian brothers, and we're continuing on with our money series. Next one up is conventional versus non-conventional financing, long-term financing, okay? So Tony, what is, by definition, what is the difference between conventional financing and non-conventional financing?
Conventional financing is basically financing that you're going to go get approved for from a bank or an institutional lender where you have to qualify your income.
Okay. What is non-conventional financing?
Non-conventional financing is, again, it's institutional lending for the most part, where you don't necessarily qualify income-wise.
Okay, so how can somebody use non-conventional financing for long-term investment financing?
Well, the idea is you want hard money, but you want what one would argue is long-term hard money.
So it's asset-based.
Mm-hmm.
Okay, so if you're not taking a qualified borrower, right, that can go get that conventional lending, what are you looking at for conventional then?
Usually it's basically the debt service of the property. So if I'm going to loan you the money to keep that property as a rental property, if I had to take that house back, what's it going to rent for, and would I be able to cover the monthly payment on it?
So since it is asset-based, right, the cash flow matters. Now that changes between lenders, but overall there's some form of cash flow.
Yes.
What are the differences for borrowers? Let's just say conventional traditionally has overlays. Let's just say there's 10 that they're allowed to get, 10 properties for conventional financing. How is that different from non-conventional?
As long as each property stands alone and performs and
covers that debt service?
Yeah, it covers the debt service. We'll keep loaning to you.
So there isn't a cap now, so you can also
Again, on a very broad spectrum, yeah, there isn't usually. I mean, the idea is that investors, they're business-to-business loans, so as long as the property itself stands and covers its debt load, then we will keep loaning you money to build your portfolio.
What about borrowing as an entity? So some conventional lenders don't allow you to borrow directly into an entity, right?
Yeah, most of them want them to be in your personal name with your own personal reporting to your credit report and on a personal guarantee.
So you also just mentioned reporting to credit.
Mm-hmm.
Some non-conventional financing, right, for investments, they don't report to credit, right? So
most don't, correct.
Okay, so how does that affect the borrower? What are the benefits of that?
It makes the borrower be able to continue to operate on their day-to-day basis, on their daily life, without having to show $10 million in annual income because they have all these mortgages, right? So the benefit of them not reporting to your credit report is the fact that it keeps your business and your personal life separate.
But it's not going on, showing up as an extra mortgage and affecting that person's personal DTI.
Yeah, right.
It's
keeping your business
Yep.
separate from your personal. I think I just said that.
Yeah, I know, but I was just trying to, keep it simple, stupid thing.
So what is it that makes borrowing non-conventional better than, say, going conventional?
Also, they're significantly faster closing times. So let's say you're in a hard money loan, you might not have the 6 months or however long it is, right, to do that refinance conventionally without paying maybe an extension fee on your hard money loan, stuff
So
like that.
the availability to getting the loan is significantly faster.
Yeah, significantly. I mean, on average.
So the road to financing is easier.
Yeah, they're usually, let's just say 30 days.
Well, if you're lost, then they're lost.
Yeah, absolutely. So typically they're about 30-day close times, maybe sometimes less. They are a lot less underwriting and qualifications you have to do. You're not doing the 12 months bank statements and W-2s. Okay, you just need to show, typically it's some form of liquidity just so you can float that loan, whatever the PITI is, for let's just say 6 months. So there are significant less requirements on that end.